The housing data for April was recently released, and it shows that our property markets have in fact slowed down. Prior to this, our housing market was growing at the fastest rate in 32 years, and it felt like the growth would never end. The amount of growth that we have seen in 2021 is nothing short of amazing, and it is great for property owners like myself, but I can definitely feel the pain of the first home buyers who are trying to get into the market. The frustration that they must feel every time they outbid at an auction or when their offer is rejected in favor of a higher offer. In some of my previous videos, I did mention that the market could slow down in the coming months as affordability constraints kick in and as more stocks are hitting the market. In today's video, we are going to take a deep dive into the April data and find out exactly what's happening in the property market and why it is slowing down, and discuss why I think this is exactly what our property market needs and why this makes me even more bullish on property in the long run, as well as what is likely to happen in the coming months as our property market transitions from a feeding frenzy to a more balanced market. As always, this is not financial advice and I am not a financial advisor. I'm simply sharing with you my personal opinions and strategies, and I will always recommend you to do your own research and seek the help of real financial experts before jumping into any investment or financial decisions. Let's start by talking about how our housing market performed in April. Despite the slower rate of growth, it was still a very impressive month, and our national house values jumped by 1.8%, and all of our capital cities saw very decent growth. As we can see from this table, despite the growth in most of our capital cities slowing down, the numbers are still very impressive, putting our capital cities on the path to see solid double-digit growth in 2021. Now, this slower rate of growth is, in my personal opinion, exactly what we want to see in the property markets because it provides us with a return that beats inflation and it reduces the chance of a property crash or government action. I will talk about these topics in a bit more detail later on in the video, but the slower rate of growth will mean that those who have paid too much of their properties or who FOMO'd into the market expecting to see unrealistic results going forward will be somewhat disappointed with the growth that they are going to see in the coming years. This will be a bit painful and disappointing in the short term, but if they have the ability to hold on to these properties in the long run, it shouldn't make a huge difference, and these properties should do really well for them in the next 10, 20 or 30 years. Moving on, as we can see in this graph, houses continue to outperform units, and this has been a trend for quite a long time now. We have talked about this before in my previous videos, but while the unit market has seen some pretty decent growth in the last 12 months, there are those markets in Melbourne and Sydney, particularly those markets filled with apartments that are still struggling till this day. If you have been watching my previous videos, then you will know that I hate apartments, and this is exactly why. Even in this period of high inflation, those apartments are still not growing at all, and some are even decreasing in value. Now, let's talk about something that is going to have a dramatic effect on our housing markets in the coming months, and that of course is the level of supply entering the market. One of the biggest drivers for the insane level of growth that we have seen in the last few months has been interest rates. The record low interest rates has made it extremely easy for homeowners to service their mortgage, and at the same time it has made it very easy for borrowers to borrow more money and drive up house prices. So as people borrowed more money to drive up house prices started increasing dramatically, and at the same time homeowners had lower mortgage repayments because of the lower interest rates. This gave the homeowners almost no incentive to sell their properties. However, due to the insane level of growth that we have seen in the last few months, homeowners around Australia are more open to the idea of selling their properties into a hot market under perfect selling conditions. In fact, more and more homeowners are now taking advantage of this and listing their properties. According to data released by CoreLogic, our most recent property boom has given the Australian housing market a valuation of more than $8.1 trillion. And this has led to a lot of investors and homeowners deciding to sell to cash in their profits. Once again, referencing data released by CoreLogic, 40,630 fresh listings were added to the market in April, which is significantly higher than the previous 2 years and 14% higher than the 5-year average. With interest rates likely to remain low in the near future, as well as the possibility of government intervention less likely now because of our property market cooling on its own, this increased level of supply is likely to be absorbed rather quickly by the crazy demand that we are seeing in our markets. However, I believe this trend of more properties coming onto the market is going to, in the coming months, reduce the level of competition and return our markets from a feeding frenzy to a more balanced market. So what should we expect in the coming months? Well, in my personal opinion, we are likely to see the rate of growth slow down maybe even further as more and more listings start to hit the market. Another factor that could be an early indication that the growth in our markets could slow down even further is the level of first home buyer activity. During 2020 and 2021, first home buyers have been the main demographic driving up house prices in our markets because of various government schemes. However, if we look at this graph showing the level of first home buyer mortgage commitments, after the parabolic rise we saw in the first few months of 2021, this line has actually started to decline. While this is only a small decline after a huge uptrend, it could be an early indication of affordability constraints as prospecting buyers are starting to simply give up. From talking to my viewers and my friends who are currently looking for a property, as well as real estate agents who sell those properties, many first-home buyers are simply giving up altogether because they are unwilling or unable to pay the crazy prices required to secure a property under the current market conditions. And who could blame them? With most properties in most markets going well above the quoted range, and buyers having their offers repeatedly rejected in favor of higher offers, I can definitely understand their frustration. So with more buyers leaving the market and more properties coming onto the market, I believe this is going to create a much better balance, meaning buyers will actually be able to make reasonable offers and have those accepted. However, there is another factor that could upset this balance, and that is shown in this graph that I'm about to show you, which shows the level of new loans and who's taking up these loans. This graph released by the Australian Bureau of Statistics once again shows a slowdown in first home buyer activity. However, we can also see that investors are now taking up a lot of new loans, and for the first time in a long time, investor loans have surpassed first home buyer loans. It will be very interesting to see how this level of increased investor activity is going to affect the market in the coming months, and which markets these cashed up investors will be targeting. If I had to guess, in the coming months there will be a shift away from Melbourne and Sydney and into the more undervalued markets where we can find both rental returns and capital growth. Even with investors returning to the market, I believe the rate of growth going forward is still going to slow down because investors are less emotional and they are less likely to overpay for properties, meaning we are less likely to see properties go for 20 to 30% above reserve. I know a slower rate of growth or a safer rate of growth is not a headline that's going to get a lot of attention, but I personally believe this is exactly what we need, and I would definitely prefer this over the crazy levels of growth that we have seen in the last few months. This simply makes the property market more stable, more sustainable, and more healthy in the long term. The last thing we want is for our property market to grow by 25% a year and then have our governments and APRA step in to cool the market, both of which are likely to lead to a correction in the property market. A more optimal outcome will be a 10 to 15% growth that is in line with inflation, which also gives wages a chance to catch up. Now let's talk about why this slower rate of growth makes me even more excited and bullish about the property market, without having to worry about government intervention and the property market growing at an unsustainable level, which is going to cause a correction, as well as me being able to find and negotiate better deals. And I believe this opinion is shared by many other investors, and that's why so many have decided to return to the market. If you have been watching my previous videos, then you will know that one of my main strategies is to negotiate with vendors and find properties that are way below market value. And that is simply very hard to do right now under the current market conditions. In the long term, I still have absolutely no doubts that property is going to do really well for me and build me a lot of wealth. But in a more balanced market, I can purchase better properties and at better prices. Let's talk a bit about the Family Home Guarantee Scheme, which will allow single parents with dependent children to purchase a home with only a 2% deposit, as the government will provide a guarantee of 18% of the purchase price. There are definitely some merits to the scheme, with the most important one being its ability to help single parents find homes for them and their children, which I absolutely love and support. However, I also think this does come with some risks. Part of the reason why I would always encourage saving up for deposits is that it builds good saving and financial habits. By allowing people to get into the market with only a 2% deposit, it will definitely help single parent families find a home faster. But do these buyers really have the right saving skills and the financial habits to service these mortgages over the long term? We are at record low interest rates, and we can only expect rates to go up in the long term. This means additional financial pressures for someone servicing a mortgage on their own, especially when they have a dependent. The last thing that we want is for a single parent to overstretch themselves financially to get into a house under this scheme and then being evicted due to their inability to make repayments in the long term. With that said, I really support what the government is trying to do here, and I hope this scheme works out for these hard-working single parents. Having been raised by a single parent myself, I definitely know the hardship that these single parents go through, so good on the government for giving them a hand. Ultimately, it will be up to the banks to make sure they are only lending out money to those who can afford it and have the ability to service it over the long term. Just before I conclude the video, I want to thank you guys for watching until the very end, and I would like some feedback from you guys. What kind of videos do you guys want to see? Please let me know in the comment section below. Alright guys, this brings us to the end of the video. I hope you guys got some value out of this. If you did, please do me a huge favor by hitting that like button right there, commenting your thoughts, and subscribing to the channel for more content just like this. And I'll see all of you guys in the next video.